And I'm sure Steve's going to talk about this, that the economy doesn't seem to be suffering under the weight of these current interest rates, even though the Fed is much higher than the rest of the world on policy rates. And the second part of that is, of course, that if the Fed does 25, it's still a dovish move.
Well, it could be a hawkish cut. And Leisman's thrown out that too, right? If they cut 25 and leave us with the feeling like, all right, you got your little lollipop here, everybody, and now we're going to wait and see.
Yeah. I think the market reaction, of course, is really how people are positioned. And we, at Fundstrat, we're finding a lot of investors are positioned as if we're going to see a pickup in inflation. So to them, they were expecting a really hot PPI number, thought this was going to start a decline in stocks. And that's why I think markets didn't fall as much, because I think many people have been positioned for a sort of a hot set of PPI numbers.
So that's the bull case from Tom Lee. And honestly, it's a very compelling story. He's a prominent voice for a reason. But while that narrative is playing out on the surface, the data underneath is telling a completely different story. One that suggests the big institutions are quietly heading for the exits. Look, if you're short on time, here is the single most important takeaway. I find that while the price of the S&P 500 is going up, the volume of money flowing out of the market is actually outpacing the money flowing in. And this paints a very interesting technical picture and potentially a lesson about risk control. If you want to understand what the data is really saying, not just the headlines you see on TV, make sure you subscribe. My name is DataCat. I used to be an analyst inside a Fortune 50 company. My job was basically herding spreadsheets, which is about as fun as it sounds. I traded that in for this. My channel is only about a month and a week old, and the support has been, well, it's been more than I expected, so thank you for that. Okay, back to the story. Right now the market is a battlefield between two completely different stories. On one side you have the bull case. This is the story you're hearing from very smart, very respected people like Tom Lee. His argument is powerful, and it's built on an idea called the pain trade. Think of it like this. There are trillions of dollars held by big institutions, hedge funds, that have been sitting on the sidelines, skeptical of this rally. They've been waiting for the sky to fall since April. The market, however, is only focused on one thing: the Federal Reserve cutting interest rates. As long as the economic data isn't a complete disaster, the market assumes a cut is coming. So as the S&P 500 keeps grinding higher, it inflicts maximum pain on all those funds sitting in cash. Their fear of missing out starts to become greater than their fear of a downturn. At some point they are forced to give up, to capitulate and buy into the market at these very high prices. That buying pushes the market even higher. This is the entire basis for Tom Lee's target of 6,600 on the S&P. It's a compelling story and he might be right. But my job isn't to follow stories. My job is to follow the data. And the data that I'm seeing, well, it's telling a slightly different story for now. It's like seeing a cat purring on your lap. It seems happy, but you notice its tail is twitching and whipping back and forth. Something is off. On the surface, if you just look at a price chart, everything looks fantastic. The SPY closed at $643.44 on Friday. It's less than 0.5% from its new high. It's trading above all the key moving averages: the 20-day, the 50-day, the 200-day. The long-term trend is strong. But that's the surface, that's the narrative. When we look underneath, we see some serious cracks forming. And this starts with the most critical warning sign: the footprint of the smart money. This is the divergence between price and money flow. Think of the RSI as your car's speedometer. Right now it's at 65.6, which is strong. It says we're moving fast. But the MFI, the money flow index, which I specifically added on the plot this time, yeah, the yellow line, is similar but also includes volume. That's the fuel gauge. While MFI usually follows the trend of RSI, it collapsed to 44.28 on Friday. This is a severe divergence. Our speedometer says we're accelerating, but our fuel gauge is dropping toward empty. You cannot maintain speed for long when you are running out of gas. It's not just one indicator. The on-balance volume confirms the story. Over the past 20 days, its slope has been negative. In simple English, it means that on days the market goes down, the selling is heavier and more determined than the buying is on the days the market goes up. The big players appear to be using the market's strength, these new highs, as an opportunity to unload their positions to retail buyers who are chasing the price. Next, we have the problem of the stretched rubber band. The market is extremely overextended. The price is now 9.31% above its 200-day moving average. That is a huge deviation from its long-term average. A market can only stretch so far from its baseline before it has to snap back. It's called reversion to the mean, and it's one of the most powerful forces in finance. And even the daily price action is showing weakness. Last Friday, we saw a classic gap and fade. The market opened higher on enthusiasm, but sellers took control almost immediately and pushed the price down to close negative for the day. It shows a serious lack of stamina. So what does this all mean when you put it together? Last week was not a healthy, broad-based rally. It is a narrow, momentum-driven advance fueled by a single narrative, a dovish Fed. The market isn't just expecting a rate cut anymore, it has fully priced in a perfect outcome. As one guest on TV put it, the market has already eaten the lollipop. The primary risk now is what's called a hawkish cut. This is where the Fed does cut rates by 25 basis points, but then Jerome Powell gets on the microphone and says something cautious. You know his style. He'll talk about being data dependent, or he'll call inflation sticky. If that happens, the market, which has priced in absolute perfection, will be massively disappointed. And because the technicals are so weak, because the smart money has already been selling, there won't be strong hands there to support the price. The floor could fall out very quickly. The first logical place for the market to fall to would be the 50-day moving average, which is currently around $620. That's a drop of over 3.5% from here. Look, I want to be clear. Tom Lee is a brilliant analyst, and that pain trade scenario could absolutely still happen. I am not telling you to sell everything and hide in a bunker. I'm an analyst, not a fortune teller. His chance of being correct is logically much higher than mine. My point is that the data shows an enormous amount of risk building up just beneath the surface. What I'm trying to say is, if you choose to add your position, this is not a time for complacency. It is a time to be disciplined, to manage your risk, to know your exit points, and to not get hypnotized by a rising price that is disconnected from the underlying flow of money. What do you think? Is this a fragile rally that's about to break? Or is the pain trade just getting started? Let me know down in the comments. If you got any value from this data-driven perspective, a subscribe would be great. Now if you'll excuse me, I have a very important meeting with a sunbeam on the carpet. DataCat out. Stay safe and stay sharp out there.